In 1945, Korea was one nation, one currency, one economy. Today, it's home to the widest wealth gap between two neighboring countries anywhere on Earth. South Korea's economy is roughly 50 times larger than North Korea's, and yet in 1960, North Korea was actually the richer half. So what happened? This isn't just a story about ideology or war. It's a story about central banks, currency reform, foreign debt, and a regime that chose missiles over markets. This is the financial history of how one peninsula became two irreconcilable economies. Before 1945, Korea had been a single economic unit under Japanese colonial rule for 35 years. The industrial base, factories, hydroelectric dams, mining, sat overwhelmingly in the north. The agricultural base, rice paddies, farmland, food production sat in the south. It was, in effect, one integrated economy where the north made things and the south fed people. When Japan surrendered in August 1945, two American colonels reportedly used a National Geographic map to draw a dividing line at the 38th parallel in less than 30 minutes, splitting occupation zones between the Soviet Union and the United States. Neither side was thinking about economics, but that line severed factories from farmland, resources from labor, and one national bank from its own currency system. Within 3 years, two separate governments emerged, the Republic of Korea in the south and the Democratic People's Republic of Korea in the north, each issuing its own currency, the won, from 1947 onward. The single Korean economy that had functioned as one unit for decades was now legally and financially two. Here's the detail most documentaries skip. For the first 15 years after the split, North Korea was wealthier. North Korea inherited the colonial-era heavy industry, chemical plants, hydroelectric power, mining operations largely intact. It received substantial reconstruction aid and technical assistance from the Soviet Union and China after the Korean War, from 1950 to 1953, devastated both halves. Central planning in this early phase allowed Pyongyang to rebuild fast, forced industrial output, state-directed labor, and steady allocations from its communist patrons. South Korea, meanwhile, was one of the countries on the planet in the 1950s and early 1960s, poorer than much of sub-Saharan Africa at the time. It had inherited the agricultural half of a broken peninsula, a government riddled with corruption under president, and almost no industrial base of its own. The turning point wasn't ideology, it was financial strategy. In 1961, General Park seized power in a coup and made an economic bet that would define the next half-century. Instead of import substitution, South Korea would pursue export-led growth, financed by an unusual mix of foreign borrowing, directed bank credit, and critically reparations money from Japan. In 1965, South Korea normalized relations with Japan in exchange for roughly $800 million in grants and loans, a controversial deal that funneled capital directly into industrial projects like POSCO Steel and the Expressway. Park's government also created massive state-directed lending programs, funneling cheap credit to chosen conglomerates, the Chaebol-like, and LG on the condition that they hit aggressive export targets. This was industrial policy financed through the banking system. The state controlled interest rates, allocated credit to favored firms, and used foreign exchange reserves as a scoreboard for success. It was risky, sometimes corrupt, and unapologetically state capitalist, but it worked. Between 1962 and 1994, South Korea's economy grew at an average of roughly 8% a year, a period historians now call the miracle on the Han River. North Korea took the opposite bet. Self-reliance, or juche, a doctrine that treated foreign capital, foreign trade, and market pricing as ideological threats rather than tools. The consequences were structural. With no meaningful access to international capital markets, North Korea couldn't borrow the way South Korea did. When it did take on foreign debt in the 1970s, largely from Western banks eager to lend to resource-rich communist states, it defaulted. North Korea's default on Western loans in 1974 effectively locked it out of global credit markets for the rest of the century. No IMF access, no World Bank financing, no meaningful foreign direct investment. Its currency, the North Korean won, was never convertible on international markets. It had no real external value, which meant the regime couldn't use exchange rates or trade the way a normal economy does. Combined with the collapse of the Soviet Union in 1991, which had propped up North Korea with subsidized oil and trade, the result was catastrophic. North Korea lost its main trading partner overnight, and by the mid-1990s, the country entered a famine, known as the Arduous March, that may have killed hundreds of thousands to over 1 million people, driven substantially by the total failure of its centrally planned distribution system. South Korea, by contrast, weathered the 1997 Asian financial crisis, a genuine near collapse involving IMF intervention and currency devaluation. and came out the other side within a few years, largely because it had built institutions connected to global capital that could be restructured, refinanced, and reformed. This financial divergence is exactly why the two Koreas remain hostile today, not merely politics, but budget allocation. North Korea, cut off from legitimate trade and lending, redirected its limited resources toward its military and nuclear programs, which now consume a share of GDP that would be unthinkable for almost any other economy. Some estimates put military spending north of 20 to 25% of GDP, compared to roughly 2.5% in South Korea. Facing sweeping international sanctions, since its nuclear tests began in 2006, North Korea has increasingly turned to unconventional revenue streams to fund its weapons programs. State-sponsored cyberattacks and cryptocurrency theft, estimated by UN investigators to have generated well over $1 billion in stolen crypto assets in recent years. Overseas labor export, where North Korean workers are sent abroad and their wages are seized by the state. And illicit trade in coal, weapons parts, and counterfeit goods that circumvent the formal banking system entirely. The short-lived Kaesong Industrial Complex, a joint economic zone just north of the border where South Korean companies employed North Korean workers, was one of the only real economic bridges between the two states. It shut down permanently in 2016 after a North Korean nuclear test, a symbolic and literal closing of the last major financial link between the two economies. By the most recent estimates, South Korea's GDP sits somewhere around $1.7 trillion, with a per-income near $35,000. North Korea's entire economy is estimated at roughly $30 to $40 billion, with a per-income that may be under $1,500. Some estimates put it far lower still. That's not a gap. That's two entirely different financial universes operating on the same peninsula, separated by 160 miles of border and 80 years of divergent monetary policy. South Korea chose integration with global capital, directed credit toward export industries, and absorbed painful reforms when crises hit. North Korea chose isolation, defaulted on its debts, lost access to the global financial system, and now funds its survival through sanctions, evasion, and cybercrime. The DMZ isn't just a military border. It's the most extreme case study in economic history of what happens when one half of a country plugs into global finance, and the other unplugs entirely. If you found this breakdown useful, subscribe for more deep dives into the financial history behind the world's biggest conflicts. And let me know in the comments which divided economy you want covered next.